Hi. Let's learn about gamma in investing and how it is used. Gamma measures the rate of change in an option's delta for every single point move in the underlying asset's price. Gamma is a measure of how the rate of change of an option's price will change with fluctuations in the underlying price. Gamma is important because it accounts for convexity issues when engaging in options hedging strategies. When the option being measured is deep in or out of the money, gamma is small. When the option is near or at the money, gamma is at its largest. Gamma is also largest for options with near-term expirations relative to longer-dated options. Gamma is the first derivative of delta and is used to gauge the price movement of an option concerning its proximity to being in the money or out of the money. It's important to understand that gamma is at its highest when the price is at the money. It's used to measure how the delta will change as the underlying asset changes. Gamma helps traders get a more precise picture of how an option's delta will change over time as the underlying price changes. It decreases as an option gets deeper in or out of the money and is at its highest when the price is at the money. The calculation of gamma is complex and requires financial software or spreadsheets to find a precise value. However, an approximate calculation of gamma is possible using the difference in deltas as the underlying asset changes. An example of gamma in action would be a stock trading at $10 with an option having a delta of 0.5 and a gamma of 0.10. For every $1 move in the stock's price, the delta will be adjusted by a corresponding 0.10. This means that a $1 increase will mean that the option's delta will increase to 0.60, and a $1 decrease will result in a corresponding decline in delta to 0.40. A long gamma position will see an ever-increasing delta as the underlying price rises, or ever-decreasing deltas as the price falls. This can lead to net profits by incentivizing the trader to consistently buy low and sell high. It gives traders the ability to sell deltas as prices rise and then buy deltas as prices fall. For options positions that are short gamma, there is a risk that price movements in the underlying will cause compounding losses. As the underlying rises, the options will lose more and more money, and if the deltas are bought at these ever higher prices, the underlying asset can reverse direction and fall, creating long deltas on the way down, compounding those earlier losses. Gamma measures the rate of change in the delta for each 1-point increase in the underlying asset. It is a valuable tool in helping traders forecast changes in the delta of an option or an overall position. Gamma will be larger for at-the-money options and goes progressively lower for both in and out-of-the-money options. Unlike delta, gamma is always positive for being long both calls and puts. Here are 5 key takeaways. 1. Gamma measures the rate of change for an option's delta based on a single-point move in the delta's price. 2. It is a second-order risk factor, sometimes known as the delta of the delta. 3. Gamma is at its highest when an option is at the money and is at its lowest when it is further away from the money. 4. Gamma is also highest for options closer to expiration than farther dated ones, all else equal. 5. Delta gamma hedging immunizes an option's position against moves in the underlying asset. Hope this would help. Thanks for watching.